Hello everyone, welcome back to my channel. So this video marks the end of the week number 53 in this road to 100k realized return challenge, and this has been basically a week of two halves. The week started rather smoothly. There were a lot of earnings releases this week, and I think the main highlight to come from that is the fact that most, if not all, of the Magnificent Seven technology stocks beat their earnings estimates by analysts, and so the market took it pretty casually, and things remained relatively stable. However, things started going awry on Thursday, especially in the aftermath. I would say they even started on Wednesday night, but things started to take a turn for the worse really on Thursday, and I'm going to show here the QQQ, which is, as you know, the ETF that tracks the Nasdaq. And looking here at the weekly chart, you'll see that there was a gap, opening gap here to the upside, but then things started to go downhill, even though the GDP came out as positive and exceeded expectations. But then the big highlight was the fact that in the press conference for of the Fed, in which the interest rate was announced, the announcement that interest rates will be steady, will remain the same, and there is no expectation about what's going to happen in the next few months because of the impact of tariffs in the economy, and also what's going to happen in the job market and with inflation. The Fed did not give any sort of certainty or hint about whether it's going to be cut rates even at the next meeting in September, even though there were two members of the Fed of the Fed that basically went against that decision and expressed their desire to lower interest rates. But even so, this level of uncertainty started to weigh in on the markets, and things started to come down basically. And then on Friday, the market really took a big tumble in light of U.S. President Trump announced new tariffs, especially to its remaining partners like Canada and other ones, and also because of the fact that the jobs report came worse than it was expected. Here, as you can see, it was expected that 100,000 new jobs would be created, but instead it was only created 73,000 jobs. But probably most serious was the fact that the numbers for June and for May were revised down in a combined number of over 250,000. And I have the news piece right here. As you can see, this is a news piece from yesterday on Friday, and the US added just 73,000 jobs on July, and numbers for prior months were revised much lower. So, and here is the big one. The June and May totals were revised sharply lower, down by a combined 250,000 from the previous levels. And in light of this development, suddenly all the ring bells are are ringing, alarm bells are ringing, because apparently the job market is not where people thought we would be, and that's why now there seems to be some big alarm in the market. Apparently the disillusion about things have been going very well in the economy perhaps is not what cracked up to be, and markets now woke up for that. And also probably it also weigh on the market the fact that Trump announced the decision to fire the labor. Let me try to see. Yeah, yeah. This is the news piece. So, U.S. President Donald Trump fires labor statistics boss after hours after the release of week jobs report, and so basically, yeah, he accused or pointed out to the fact that because it's a Biden appointee, he wants to do harm to his presidency, and so that's why he fired this person, the head of the Bureau of Labor Statistics, and I don't know what exactly what this means. Whether if the person was if the labor statistic the Bureau of Labor Statistics actually did anything intentional or not, I think that's up for debate. But the fact remains that apparently the job market is deteriorating, and that also is the reason why this big tumble in the markets took place. And when it comes to our trades, we we managed to get a quite significant return in terms of premiums, even though of course we took the tumble in the chin on the chin in terms of the IWM, but still we managed to get some good profits out of the premiums, especially here on Wednesday, in which we managed to get more than $1,000 on this particular set of 12 calls. But, and it's probably easier to show here, if we take out this mark-to-market value, which is not really what matters, and also this one, I'm going to get to this trade in a few seconds, but here, as you can see, in terms of the week itself, we managed to get a little bit more than $2,156, which is quite good nonetheless for a single week. But now, of course, we have to expect that next week is going to be anything but this, and profits from premiums will be much lower. In terms of the IWM itself, we will have to expect that we will not be able to have to sell any calls on the strike price that we want for for the 0DT options, and so probably the most likely factor that we will have to adopt, or the decision that we'll have to make, is to do a weekly option and expiring on Friday next week and try to get some more premium out of it. All right, we are not going to play games in this market because after all things are very unstable. A spike can happen at any point in time, and if we caught up with options with a lower strike price than our acquisition price, chances are we're going to incur in a loss, and we don't want that. Now, as things stands at the moment, and given the premiums that we got from these two calls over here, our the price at which we would break even on these stocks, shares of IWM, is if we would be able to sell them at $222.49. But even so, and oddly enough, there is a call option with exactly that strike price. So if we sell this call option and it is assigned, we would break even. Actually, we would have a capital loss, but the premiums already accrued would bring us to break even. We will have a very tiny profit on this, but I think it's not worthwhile. And I think we're going to err on the side of caution, and we are just going for this one, the 224 strike price call. We would break even on the price, and we'll still keep the premiums and continue to accrue more premiums. I think the difference between the premiums here is not that significant that would justify to take that kind of risk and risk having a capital loss, because at the end of the day, if you think about it, currently the market closed the week at 2015.19. So if we do this calculation, for example, 222.5 divided by 215.19. So this is just a difference. So the market would have to rise by 3.4 approximately percent from where it sits at the moment to this strike price. And keep in mind, this would have to happen over 5 trading days. It's absolutely possible. Just to keep in mind, for example, let me see what it is. Yeah, here. To the power 0.2, because that's over 5 trading days. The market would have to rise on average 0.67% over the 5 trading days to reach this one. And so I think the chances are too great, and we really don't want to take that risk of having a capital loss, even though we would break even for the most part because of the premiums. The probability of profit here is 83%, but of course this can change very quickly. Here is a bit higher, it's 87%, but still it would make all the difference in terms of breaking even on the price. So this is most likely the plan for the week, and because of that, if we, for example, use this price for these calls, which will not be there, of course, it will be less because the weekend has passed, we will collect, in this case, around $444. So count on collecting less because the time will pass, a whole weekend will pass. And so, yeah, the profits next week will be much lower than they were this week. But yeah, that's the way it is. It's what the market gives to us. That's what we have to take. Now, as you can see here, we also acquired 100 shares of the XLF. This is a ETF focused on financial firms, and we because we had some premium left over on, let me see which day it was. I believe it was on Thursday. Yeah, it was on Thursday that we sold one put contract with a strike price of 51.50. And as you can see here, over the week, yeah, this is exactly where we did. So the price was trading around between 52.80, 52.60, and keep in mind the historical volatility of this is only around 12%. The volatility now is heightened to 18.4 because of all the uncertainty and the instability that we are facing at the moment. But I recall, and I recorded this in here, that the probability of profit was 92%. I really was hoping that this put would expire worthless. It was only 2 days, so Thursday and Friday, left in the option, and given this low volatility, the price really had to tumble down in a very big way for the options, for the put to become in the money and be assigned. But unfortunately, that's exactly what happened on Friday. So you'll see that even for such a low volatility ETF, these things can happen. Of course, we had the money to back it up, but still, nonetheless, it was something that was completely unexpected. The stock recovered to close to our strike price, but it didn't finish. It still did finish below our strike price, so we were forced to acquire the shares. And yeah, we'll have to sell calls next week on this. We are going to sell one call at the same strike price here, and we will get these $48, which is quite good, I should say. Of course, it will be a little bit less because of the weekend has elapsed, but still, it's very good. It will be a very good premium. We attempt to break even on the price, of course, and then still keep the premiums for ourselves. As you can see here, the price 51.50, and we still collected 5 cents on the way, or on the selling of the put. But yeah, one detail that I failed to mention is that the last call we sold on WM was on the 2 days, because since the stock went down in a big way below our strike price already on Thursday. The premium for the 0DT option was around 7 cents, and because it was 7 cents, it was far too low for what we are looking for, and so we sold the 2-day option. As you can see here, on Thursday we sold an option expired on August the 1st, and we collected so it's about 6.5 times more, just because we extended for 1 day. So this was a no-brainer decision. We collected $540, which are of course right here, discounting the commission. But yeah, this is where we stand at the moment. We are going to put back our values here. We still, given the fact that we collected 5, we paid the commission, and we still, given the price 51.47 at which it ended the week, XLF, we still managed to stay in the green, which is funny. But still, we have to keep in mind that, yeah. Oh, this is not correct. This is not the correct one. This is the one. Yeah. So that's the way it is. We'll have to see what's going to happen next week. My concern was that not having any options for the week, I could have extended a little bit more our exposure to options on IWM, because as soon as markets open on Friday, here, as I can show you, yeah, as soon as the market opened here on Friday, this option that we had basically went worthless. It was already at 1 cent, so it was no longer open for trading. We could just buy it back at 1 cent. But I decided not to do that, and the reason is because if we extend the maturity of the option, it's possible that the market simply saw that probably that it was an overreaction. It could go against us, it could go in our favor, but if the market realized that it had an overreaction, or is there some positive news over the week, whatever, we would miss out on a lot of premium, because the market in the meantime will recover, but we are already with a call position on the shares. So let's wait and see what happens next week. If the stock recovers, we'll be getting a little bit more premium. If continues this downhill trend, yeah, we will continue. We'll have to probably extend our maturity even further, but that's the way it is. We have no way to know what's going to happen in advance. We will just do what we believe it best with the information that we have at the moment. For the time being, oddly enough, completely in counter cycle to what the market was doing, Pfizer went up by more than 1%, talking about strange behavior. But still, we're going to wait until there's a better price for us to sell these shares and basically forget about this experience with Pfizer. We cannot do anything more except selling calls. We have almost no buying power at this point, but it's okay. We will be able to collect more premiums on the calls, and when we had more premiums, we will sell more options to get more premium out of it. So for the time being, this is all. Feel free to leave your comments in the comment section below, and I'm also available on LinkedIn in case you have any questions. And of course, feel free to like the video and subscribe to the channel, and we'll reconvene next Monday to start the week number 54 in this challenge. It's going to be a challenging one, and of course much lower premiums we'll be able to collect, but that's how the market is, and that's where we are going to roll. This is how the markets are, as cruel as they can be. And yeah, I'll see you there.